October 1907. In the offices of the most powerful banks in New York, terrified men are watching the American financial system come apart in their hands. Crowds are forming outside banks, people desperate to pull out their savings before it is too late. Institutions are collapsing, and there is no government body, no central bank, no official rescue coming. Instead, the fate of the entire American economy rests on the shoulders of one aging private banker sitting in his library, deciding almost single-handedly which banks will live and which will die. His name is John Pierpont Morgan, and the crisis he is fighting is remembered as the Panic of 1907. Most people think this panic began with a failed scheme to corner the copper market on Wall Street, and that scheme was Spark. But the real origin of the Panic of 1907 lies somewhere else and entirely, 18 months earlier, and 3,000 miles away, in the smoking ruins of a devastated city. Because the story of this crisis does not begin in a bank. It begins with the earth itself tearing open. April 1906. San Francisco, one of the most powerful earthquakes in American history, strikes the city, and the fires that follow burn for days. A great American city is reduced in large part to rubble and ash. The human cost is terrible. But there is also a financial shockwave, one that would travel across the entire world and help set the stage for a panic a year and a half later. And to understand it, you have to follow the insurance money. When San Francisco burned, the destruction of property was staggering. And much of that property was insured, including by insurance companies based in Britain, in London. So after the disaster, these British insurers were obligated to pay out enormous sums to cover the claims to compensate for the destroyed buildings and businesses. And that money, a vast quantity of it, had to flow from London across the Atlantic to the United States to pay the claims in San Francisco. This meant a huge amount of gold, by some estimates around $100 million, a colossal sum for the time, drained out of London to cover the American losses. Now, why does gold leaving London matter for a panic in New York? Because in this era, the world ran on the gold standard, and the financial centers of the world were tightly connected. When that much gold flowed out of London, the Bank of England had to protect its own reserves. And to do that, it raised interest rates and took steps to pull gold back toward Britain, tightening credit. This tightening spread across the Atlantic financial system. Money became scarcer and more expensive to borrow on both sides of the ocean. So by 1907, the American financial system was operating in conditions of tight credit and reduced liquidity, in part because of that distant earthquake and the flood of insurance gold it had sent across the ocean. The system had less slack, less cushion, less room for error. It was stretched tight, like a wire, and a system stretched that tight is fragile. It is vulnerable. All it needs is a shock to snap it. But the earthquake only created the dangerous conditions. To understand why those conditions turned into a full-blown catastrophe, you have to understand a hidden weakness that had been growing inside the American financial system for years. The trust companies. In the American banking system of this era, there were traditional banks, national banks, that were subject to fairly strict regulations, including requirements to keep a certain amount of cash in reserve to cover their deposits. But there was also another kind of institution that had grown enormously powerful. The trust company. Trust companies were financial institutions that took deposits and made investments, much like banks. But they operated under far looser regulations. They were required to hold much smaller cash reserves against their deposits than the national banks were. In effect, they were doing bank-like business, taking in people's money, but with a much thinner safety cushion and far less oversight. Think of them as the shadow banks of their day, operating in the gaps of the regulatory system, taking bigger risks with less protection. And they had grown huge, holding vast sums of the public's money. This was an accident waiting to happen, because a bank or a trust company works on trust, on confidence. As long as depositors believe their money is safe, they leave it in the institution, and everything runs smoothly. But no bank keeps enough cash on hand to pay back all its depositors at once. It lends and invests most of that money. So if all the depositors suddenly demand their money back at the same time in a panic, the institutions cannot possibly pay them all, and it collapses. This is a bank run. And the trust companies, with their thin reserves, were especially vulnerable to exactly this kind of panic. All it would take was a loss of confidence, and the whole fragile structure could come crashing down. And in October 1907, that loss of confidence arrived, delivered by a reckless scheme and a failed gamble. It began with a man named Augustus Heinze, and an attempt to manipulate the stock market. Heinze, along with some associates, tried to corner the market in the stock of a copper company, essentially trying to buy up and control the shares to drive up the price and make a fortune. It was a risky, aggressive financial gamble, and it failed spectacularly. The scheme collapsed, and it caused huge losses. But the real danger was not the failed scheme itself. It was who was connected to it, because Heinze and his associates were linked to a number of banks and financial institutions. And when their copper scheme blew up, people began to worry about the health of all the institutions connected to these men. Fear began to spread. Depositors at banks associated with Heinze started to get nervous, and some began pulling out their money. And then the fear jumped to the trust companies. Suspicion fell on one of the largest trust companies in New York, the Knickerbocker Trust Company, which was believed to have connections to the men behind the failed copper scheme. And once suspicion touched the Knickerbocker, it was doomed. Depositors, terrified of losing their savings, rushed to the Knickerbocker Trust to withdraw their money. Crowds formed. The withdrawals became a flood, and with its thin reserves, the Knickerbocker could not possibly meet the demand. Within a short time, it was forced to suspend operations. It collapsed. And that collapse was like a match dropped in a dry forest. The panic exploded outward. If the Knickerbocker could fall, people reasoned, then any trust company could fall. Fear turned to terror. Depositors across New York rushed to pull their money out of other trust companies. Run after run erupted. The panic fed on itself, exactly as reflexive fear always does. The more institutions that seemed threatened, the more people panicked. And the more people panicked, the more institutions were threatened. The entire financial system was seizing up, freezing, on the edge of total collapse. And here is the crucial point that is so hard to grasp today. There was no one to stop it. There was no central bank. There was no Federal Reserve, no government institution with the power and the mandate to step in, provide emergency cash to the system, and calm the panic. The United States, the largest economy in the world, had no mechanism, no official lender of last resort, to halt a financial panic. And into that terrifying vacuum stepped one man, J.P. Morgan. Morgan was the most powerful private banker in America, an aging titan of finance, with immense wealth, influence, and prestige. And with no government able to act, Morgan effectively took charge of the entire crisis himself. He summoned the leading bankers and financiers in New York to his private library, and there, night after night, he orchestrated a rescue of the American financial system. He and his fellow bankers pooled their own money and money they gathered from others to create emergency funds. And then Morgan made the decisions that no elected official had the power to make. He decided which institutions were worth saving and which would be allowed to fail. He directed emergency money to the trust companies and banks that he judged could be saved and were worth saving, providing the cash they needed to meet the panic withdrawals and survive. And for the ones he judged beyond saving or not worth the cost, he let them collapse. One private individual, sitting in his library, was deciding the fate of the American economy, choosing winners and losers, playing the role that in any other major nation belonged to a central bank or a government. And, remarkably, it worked. Through sheer force of will, wealth, and authority, Morgan and his circle managed to stop the panic. They contained the runs, restored a measure of confidence, and pulled the financial system back from the edge of total collapse. Morgan was hailed, in many quarters, as a hero, the man who single-handedly saved the American economy. But there is another side to this story, a more troubling one. Because in the middle of saving the system, Morgan also did very well for himself. During the crisis, a major brokerage firm was on the verge of collapse, threatening to make the panic even worse. That firm held, as collateral, a large stake in a company called the Tennessee Coal, Iron, and Railroad Company. And a company Morgan controlled, U.S. Steel, wanted Tennessee Coal and Iron. So as part of the rescue, Morgan arranged for U.S. Steel to acquire Tennessee Coal and Iron, framing it as a necessary move to stabilize the crisis. And he acquired this valuable company at a price that many considered remarkably low, far below what its assets were thought to be worth, from a seller under enormous distress. Now, defenders argue that this acquisition genuinely helped stop the panic, and that Morgan even secured assurances from the government that it would not challenge the deal on antitrust grounds. Perhaps. But it is also undeniable that in the middle of rescuing the economy, Morgan used the crisis to snap up a hugely valuable asset at a bargain price, strengthening his own empire, and that captures the deep ambiguity at the heart of this whole story. The same crisis that ruined many transferred wealth and power to the few who were positioned to take advantage of it. Morgan saved the system, yes, and he profited from saving it. Both things are true, and this brings us to the most important consequence of all, the true legacy of the panic of 1907. Because after the dust settled, the political and financial leaders of America were forced to confront a deeply uncomfortable truth. The most powerful economy on earth had come within a hair's breadth of total collapse, and it had been saved only by the private judgment and private wealth of one aging banker. What would happen next time when there was no JP? Morgan to step in. This was intolerable, and everyone knew it. The nation needed some kind of official mechanism to prevent and manage financial panics. A central authority that could provide emergency money to the system in a crisis, a lender of last resort. And so, in the years that followed, a movement grew to create exactly such an institution. And this leads to one of the most secretive and consequential episodes in American financial history. In 1910, a small group of the most powerful bankers and financial policymakers in the country traveled, in great secrecy, to a private retreat on Jekyll Island, off the coast of Georgia. They went to great lengths to conceal the meeting, reportedly even using only first names to hide their identities. And there, on that island, they drafted the blueprint for a new central banking system. This plan, refined and altered through the political process, became the basis for the Federal Reserve Act, which created the Federal Reserve in 1913, America's central bank, designed to do exactly what JP Morgan had done by hand in 1907, to act as a lender of last resort and prevent financial panics. And here is where the story leaves us with a genuine and lasting debate. Because who designed this new system? In significant part, the very same banking interests who had dominated the old one, meeting in secret on a private island. Supporters argue this was simply practical. Who understood the financial system better than the bankers themselves? The Federal Reserve was created to protect the public and the economy from the devastation of panics, and it was shaped by public debate and elected officials, not merely dictated by the men on the island. That is a fair point, and it is true. But critics have long asked a harder question. Was the system truly designed to protect the public from the banks, or to protect the banks and to ensure that the same powerful interests would continue to control the response to every future crisis? Was it a shield for the many, or a tool for the few? This debate has never fully been settled, and it echoes to this day. So look at the full chain of this remarkable story. An earthquake in San Francisco drains gold from London and tightens credit across the world. Fragile, under-regulated trust companies, the shadow banks of their day, sit dangerously exposed. A reckless copper scheme fails and ignites a panic. Trust companies collapse in a cascade of fear. And with no central bank to stop it, one private banker seizes control, saves the system, and enriches himself in the process. And out of that crisis comes the Federal Reserve, an institution designed to prevent the next panic, but designed, in part, by the very interests who had ruled the old system. It is a story that reveals a pattern that appears again and again in history. That crises do not just destroy. They transfer power from the many to the few. And that the institutions built in the aftermath, the ones meant to prevent the next disaster, are so often shaped by the same hands that profited from the last one. Which leaves a genuinely important question, and I want to know where you land on it. Do you believe the Federal Reserve was truly designed to protect the public from financial panics, or to protect the powerful banks that so often help create them? Tell me in the comments what you think, because this is a debate that has raged for over a century, and I do not believe there is a simple answer. And if this pulled apart a story you thought you understood, if you want more history where the real cause is hidden beneath the one everyone repeats, then subscribe and stay with us. Because the next story we are opening up is another moment where the world was told one thing, while the truth sat buried in the ledgers the entire time. You will not want to miss it.